Hey, what's up everybody? It's your mortgage expert, Brian McCauley here. So you're looking to buy a house in Dallas, Texas, but you're wondering, how much house can I actually afford and qualify for on my current salary? Well, stick around. In this video, I'm going to teach you the guidelines around that and help you make a smart financial decision. Let's get into it. So listen, buying a house is the biggest investment and purchase of someone's life. The mortgage experience, getting a home loan, is not an easy one. We try to make it fun, we try to be real, we try to be clear, but our job is to protect you and drive clarity around things. Been doing this for almost 20 years. So our team is great at what we do. We want to be more than helpful, but we also want to make sure that we set people up for financial success. And so one of the challenges that we've heard in this market of inflation and things being expensive is like, man, I want to buy a house, but I don't even know what I can qualify for, number one, and two, what can I afford? So today what I want to do is share a few things with you on guidelines, right? Why you guys aren't probably interested in guidelines. I've heard so many people say like, well, my uncle told me this and I read this on Google and thought this was the case, blah, blah, blah. So I'm gonna help you self-diagnose today on how it works. And then what I'll do at the end is give you some calculations, show you how to reverse engineer to the numbers, but also show you a few tricks to where if you can't qualify right now, I can show you how to get there. So first things first, I want to get into the guidelines on how much a person can qualify for and afford based on the mortgage terms, okay? So we're going to use two numbers for today as a starting point, so that way everyone's on the same page and the math is the exact same. So the first number that we're going to use is income. So someone's salary, household income is what I'm using at this point. So I'm going to use $120,000 as the gross annual household income for this illustration. So that'll be number one. So the second thing I want you to write down is 50%. 50% is the debt to income qualification that mortgage companies will allow you to borrow against your current income. So we're going to do $120,000 of gross household income. Now, as a side note, if you're W-2, they use gross. If you're self-employed, they'll use net. If you're 1099, it's kind of a hybrid of both. So if you are, self-employed, 1099, business returns, blah, 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 it won't always be gross. But for the illustration of this, I'm going to say, hey, $120,000 a year is the total household income. That is 10 grand a month, okay? So we're gonna do easy math. Now, 50% debt to income is in the middle. A couple loan programs allow like 45, some allow 55, but I use 50% because it's easy math. We've always been taught since we were kids, divide by two, cut it in half. And so this is an easy way without tiptoeing on 43.2, 47.9. So again, for the purposes of this, how much can I qualify for based on my current salary or household income? We're gonna use $120,000 gross for the year. That's $10,000 a month. And this is what lenders do. So we're gonna use $10,000 a month in household income as the qualifying income and say, okay, the mortgage guidelines allow 50% debt to income. So what does all that mean? So it means if you make $10,000 a month, mortgage guidelines will allow you to have 50% in monthly payments as your overall debt, including the new mortgage taxes and insurance, but not including things like a gym membership and groceries and all that stuff. So what do they count in that? We count minimum monthly payments that are on your credit report. Now there are some exceptions to rules if somebody has child support or they're receiving it, or if you got a student loan that's in deferment. All these questions and comments, people are like, what about this and that? There are some things that are out of bounds, but I'm saying for like mainstream 80% of loans, the 50% debt to income is a calculation. It's not just on the house. I have so many people say, oh, well, I make 10 grand a month, 5 grand is my debt to income. I can get 5 grand in mortgage, taxes, and insurance. No, the 50% is everything that you currently have plus whatever the new is can't exceed 50. So in this scenario, $10,000 is the monthly income. 50% of that is 5 grand. So what happens is, let's say there's a couple, right? And they're renters and they've got 10,000 in income, 50% they can qualify for. Maybe they have a $500 car payment each. So that's $1,000 a month, okay? Maybe they've got a credit card payment that's $300, okay? So we're at $1,300 a month, okay? But that's it. That's all they have because we don't count their rent because the rent's gonna go away. So they're sitting on $1,300 a month in payments. Lenders do not care about the balances. The balances could be $1 million. It's whatever the monthly payment is. So if there's $500 car payment, $500 car payment, $300 credit card payment, $1,300. So if $5,000 is the maximum debt to income allowed on this person, that means out of the $5,000, $1,300 is already accounted for because they have debt already, which gives that buyer $3,700 in room to go get a house. So that's simple on how it actually works. So in that scenario, if you could do $3,700 a month, that's probably, give or take, maybe like a $450,000 mortgage at a rate somewhere around 6%. And again, that has to include the mortgage, the property taxes, the homeowner's insurance, and then private mortgage insurance if needed. So if you get a $450,000 mortgage at 6%, I'm not running the math, but I'll do it in my head. I think that'll probably be like $2,600 maybe a month. So if they get $3,700, they'd have $2,600 as the mortgage. Let's say the property taxes were $800. So now that puts them at $34. We got $300 left. Homeowner's insurance is $280. There we go, right? So we're there. Now that's very easy math on how it works, but again, if you're not in my industry, you won't know. So what I'm doing is just saying, hey, elementary is total household annual income. Divide that into monthly, obviously at 120, that'd be 10,000, 50%, 5K in debt, right? So you take whatever monthly payment you have now, subtract it from the $5,000 and say like, this is how much more I can hold based on the guidelines. Doesn't mean you want to, but what the guidelines would allow for. And then you have to go out and say like, okay, well, I want to put 10% down. So I got to get a $525,000 house and put 10% down, and that leaves me with $460, $470 on the mortgage. And so then at this rate, the mortgage payment's this, and taxes and insurance, that's how you back into it to make sure the debt to income doesn't exceed, okay? Drop questions below. I'm happy to do scenarios. I'm gonna do a live later on this year and go through some stuff as well, but as rates come down, this is gonna give people more buying power, all of this. So one of the other things to remember about qualification on home loans is if there's any extra income, bonus income, rental, all these things, but let's assume that there's not, right? You can pay off debt. So let's say your credit card balance is $15,000 and your monthly payment's $300, and you're like, Brian, we can't find a house at, $500, right? The ones that we like are at $575. I go say, okay, well, if I run it at $575 and 5% down or 10% down, what we would need to do to make that happen is, as opposed to putting 10% down, put 5% down, use that 5% to pay off the credit card. Therefore, the $300 that we were counting goes away, and now we can move the price point up. So you can always pay things down and or up to move the needle if need be. Any installment loans. So there's like credit cards are revolving all the time, okay? Installment loans are like mortgages, cars that aren't on a lease. It is a fixed period of time that you are making payments to the creditor, and then at the very end on the last payment, it becomes yours, free and clear. Unlike a lease on a car, you turn the lease back in, that can't be omitted. But if your installment debt has less than 10 payments left, or you pay it down to less than 10 payments, a lender no longer has to count that monthly payment against you. So let's say again, back to this little fake couple, their car payments are $500 and $500. Let's say one of them has a $14,000 balance on their car. The other one has a $20,000 balance on the car. Let's say $14,000, okay? So if you wanted to, you could spend $14,000, pay off the car. That would eliminate $500 for me to count. And then what I could do is stretch the buying power now to get a bigger house if we wanted to, in order to eliminate the lower threshold, because now we no longer have that payment. The other thing is, you wouldn't have to pay all $14,000 on that car. If it has to be 10 payments or less, that means $500 a month times 10 payments. That means the balance has to be $5,000. So if you go 14, you could pay it down to $9,000. And when the balance is at $9,000, now there's less than 10 payments left. So what happens is you didn't have to deplete all of your money, but you paid that installment loan down to 10 payments or less, and therefore the lender, me, says, hey, great, you had two $500 payments, you paid this down to 10 or less, I'm going to eliminate the $500, now you have even more buying power. So there are a lot of things like this on home loans that can be done in order to maximize buying power for clients. The other component about it is sometimes clients don't need to do that to qualify, but I always encourage them thinking about your life as a game show, meaning what is the highest and best use of the money? If somebody wanted to put 10% down and it moved the needle $200 on the mortgage, and I said, maybe you want to do 5% down and take the other 5% and pay off the car because you get way more bang for your buck. Do you want to spend 20 grand to save 200 on a house, or do you want to spend 20 grand and save 500 on a car? Same amount of money from the consumer, you're just pushing it into one debt versus the other. Into the mortgage, 200 bucks. Into the car, 500. That would free up an extra $300 a month. Now, people say, well, how much is that going to cost you over the life of the loan? Nobody in my entire career in 20 years has ever gotten a 30-year mortgage and made minimum payments all the way until 360. It does not happen. So do not think like, oh, well, this is going to cost me a lot. You know, my car loan's 3 years, I'm going to be in the house for 30. No, you're not. You're going to be in the house for 3 years, 5 years, 7 maybe, especially if you're under 50, you'll probably refinance. So there's always financial structure. The other thing to remember is it's okay to have a higher mortgage payment. Why? Well, there's good debt and bad debt, right? Bad debt is credit card debt. It is revolving, it is not collateralized, it has high interest rates, and it gets people in trouble. That is bad debt. Auto debt is in the middle. What I mean by that is at least the debt is secured by something, AKA a car. So if you get in a pinch, you can trade in the vehicle so you're not hard up. But cars historically go down in value and you don't get any tax deductions on the payments. Houses historically go up in value and sometimes you get tax deductions. So not only may it be a better move to pay off the car just to free up some cash flow, one of the things that you're investing in goes down and you're losing money and you get no money back. The other thing, the house you're investing in historically goes up over time and you could potentially get tax deductions. So one of them's making you money, one of them's losing you money. This one could eliminate $500 a month. This one could eliminate $2. So again, qualifications, it's important to know. I want to make sure that we put everybody in a strong position. Again, what can you afford? What can you qualify? Two different things, but we'd like to have a mortgage planning session and a discussion around it. One, so people know, but two, so we can set them up for success. And focusing on the mortgage payment alone isn't always the best thing to do because there is more to the financial profile than just the mortgage, the taxes, and the insurance, whether it be from a qualification standpoint or whether it be from an affordability standpoint. So remember, buying a house is the biggest investment and purchase of your life, and it's very important to make sure that you know the numbers, you know the rules, and you get all your financial affairs in order prior to going out to the market, which is obviously what we want to help with. So I hope you guys enjoyed this video. I hope it's educational. There's a lot of moving pieces when it comes to this, but if you got any additional questions, drop a comment below. Feel free to share the video with anybody you know that could benefit from this, and obviously like, subscribe. We like to put these videos out all the time to educate and help consumers each and every week. And if you just want to have a conversation around getting pre-approved, qualified, what can we do, what can we not do us a favor. Call us, email us, text us. I'll set up a consultation. We're always here for you. Until next time, stay tuned.